Hi, Brady Young here. Please keep in mind the video you are about to watch. We accept no liability for the content of the video. It is for illustration purposes only. Please enjoy the video. Thank you. A couple people asked me to do a little educational video on how you can talk to people about money and how you can give people a little bit of education on how money works, compounding interest, as well as maybe a couple of different investment strategies that a lot of people tend to do. So I want to talk to you a little bit about compounding interest, bank CDs, which means a certificate of deposit, and also IRAs. There's traditional Roth IRAs, and I want to talk a little bit about the traditional IRAs, how they're taxed, and why I don't think they're so great personally. And then I'll give you a couple things that I think are better options. So starting out, when I talk to people, I typically ask them, if I handed them $10,000, what would they do with it? And most of the time I don't get a very good response. I mean, people just don't know, they're not educated about money, and they just, it's not their fault, they just don't know any better. But if I were to hand somebody $10,000, they usually say, well, maybe I would put it in a bank or get a CD or an IRA. So that's what I'm going to talk about those. So let me show you how a bank CD works. Now in today's market, if you were to round up, you would earn maybe 1% interest on your money in a bank CD. And so 1%, if we took that same $10,000 and we invested at the 1% in a CD, your money, guess how long it would take for that money to actually double where you would have $20,000? It would actually take 72 years. Crazy, right? Now what you do is, this is based off of the rule of 72. And so you take any interest rate and you divide it by 72, and that's how many years it would take for your money to actually double. And so in this case, we're going to take the 1% and say you're 29 years old. So you'd be 101 by the time you had $20,000. Not a very good retirement plan. So people need to find better options out there, or higher interest rates. Now there's good protection in a CD most of the time, depending on how much money you have in there. Your money is protected by the FDIC, but you need to find better rates of interest to have a decent retirement. So at 4%, your money is going to double every 18 years. At 6% interest, your money is going to double every 12 years. And at 12%, you just flip-flop those. Now your money is going to double every 6 years. So if you can find something in these ranges, I can't promise people 12% every year. That's a little aggressive. But if you can get in between these ranges here and average that, you're off to a pretty good retirement. And so also, the sooner you start, the more money you're going to have in the end, which is obvious. But a lot of people think that you have to have hundreds of thousands of dollars to end up with a couple $1 million retirement. That's not the case. You just need to start sooner. And the sooner you start, if you're compounding at these higher rates of return, with a couple $100 a month, you can turn that into a multi-million-dollar retirement plan. So that's how a CD works, and that's why I don't like them. The interest rate just doesn't work out for people. Now, if you look at an IRA, let's look at a traditional IRA. Now, that means individual retirement account. And one of the rules with an IRA is the 59.5 rule. So you're not supposed to touch your money until 59.5. Now, unfortunately, a lot of people either need to, want to, or have to touch their money before 59.5. And guess how many people do? I'm told 92% of people, again, need to, want to, or have to. That's a lot. Now, here's what happens if you do have to do that. Depending on who's administering your IRA, you're looking at about a 10 to 20% penalty. And then you're going to have to pay tax on that money in a traditional coming out. So you're looking at about a 40 to 50% loss. And then you're going to have to pay sales tax on top of that. So if you wanted to, you're going to be looking at quite a loss before you're ever even able to really touch your money. So let's look at a 70.5 rule. That's another rule that IRAs have. So 70.5, which I think is a trick on old people because nobody really knows their half birthday, but you have to take minimum distribution, required minimum distribution, RMD. Remember that, RMD. If anybody ever mentions that, that's what they're talking about. So with an IRMD, this money is growing tax deferred. So they want you to pay taxes on some of the money in these accounts. So they make you start taking out a certain percentage every year at 70.5. They don't call the day before you're 70.5 to remind you. They call the day after to say, I'm sorry, you didn't do that correctly. An additional 50% penalty on the money you were supposed to take out. So that's not very fun. Let's look what happens if you take out your money in time, right in between here, you do everything perfectly as planned. So you're going to have to pay taxes on this. Right now with our debt, everything going on in our country, all these new healthcare laws that are coming into place, nobody knows what tax rates are going to do, but I think everybody would agree that they're going up, unfortunately. So if we end up at about 15, 20 years from now, if we're averaging 45, and I don't know, but let's just say 45 to 55% tax, which I personally think might even be a little low, again, you're looking at losing about half of what you have in your account. And then you have to pay sales tax on top of that with whatever you're buying, which is another 6 to 8%. So, it's not a very good plan. You have too many areas where you can lose money. And that's if your account even did anything. Typically, this is what you're looking at, where your account goes up, it goes down, goes up, it goes down. And so I'm sure a lot of people have seen charts like this. Now, if you looked across the board right now at people 65 and older, which is retirement age, they have less than 75% of them in our country have less than $30,000 in these types of accounts, 401ks, IRAs, and they work the same way. And so the problem is, if you look at 2001, we had about a 30% crash across the board on average, and the market did okay. We had a real estate boom, and then we had a 50% crash on average in 2008. So in a 10-year time period, people lost about 80% of what they had in these accounts. That's a lot of money to lose when you've been working for that your entire life. And so what I'm proposing to people is really what I think is a better option. It's using investment-grade life insurance or cash value life insurance to supplement your retirement income. Now, a lot of people think of life insurance as death insurance because they think it only provides them with a death benefit. Now, that's true with things like term insurance, and that's exactly what it is. It's for a specified term, and it only pays out if you die. Now, with the investment-grade life insurance, like index universal life or whole life contracts, you can have a cash value. Now, normally you come to me and say, Brady, I have 2 kids, I have a car payment, I have a mortgage, so I need about $500,000 worth of life insurance if something happens to me. So here's your cost of insurance, and here's that $500,000 wrapper. Now, according to Internal Revenue Code 7702, which has been around since 1913, a long time, you can overfund these accounts, and you can put more money into this. And really, essentially, most people want to pay the minimum for that, but I'm saying pay the maximum you can to overfund these accounts. Now, these are cool because you can make them fit for anybody's needs, and they're very, very flexible. So let's just say you have a higher income and you want to put away $10,000 a month instead of $200 a month. So what we do is we just put a bigger shell on this, the higher the dollar amount of the face amount of the insurance. So let's say this is a $2 million plan instead of $500,000. That's going to raise your cost a bit, but now you can put that much extra money in. And so every year there's a minimum and there's a maximum, according to the tax code, is what you can put in. And if it's done properly and set up correctly, you can draw money out of these plans through retirement. So typically what I'll do is I have people pay into them until 65, and then they let it sit for a few years and start pulling from this at 70 and provide them with a tax-free income stream for 30 years through retirement to make sure that they have a tax advantage plan that cannot be outlived. And it's really, really important to have a proper base in your retirement plans. People's biggest fear now is outliving their money. It's really scary. Nobody knows how long they're going to live. So if you knew the day you were going to die, you could come up with the perfect plan. But since you don't, having money until age 100, I think, is important for everybody. This plan has a built-in what's called a stop loss. So if you track the market up, if the S&P 500 goes up, you're going to go up with it. And if it dropped that 30%, you would have actually flatlined right there. And then when it goes back up, your account starts to go up. You don't have to wait for it to get back to where it was. If it goes up, say 6% here, you go up to 6%. And then it drops again, you actually flatline. It goes up, you you go up. Drops, you flatline. Goes up again, you're up again. So over a long period of time, when you can't lose, that makes a big difference in there. And so we're able to average in the last 20 years about 8.6, 8.8%, depending on what company and how you have it allocated. But you can look at some substantial compounding growth with these accounts. It's really, really cool. So I hope that helps. I hope that gives you a little bit of an idea of how these contracts work and how money works. And if you have any questions, just talk to your insurance agent or talk to a financial planner that is licensed to talk about these types of plans. And thanks for watching.